All right, welcome back to our 5 common mistakes that everyone makes in real estate accounting. Number 5, I think, gets the least amount of attention in real estate accounting, but probably needs the most attention, especially from a tax accountant, because here's what usually happens, right? Client calls and says, hey, guess what? I sold a rental property last year. Or you're doing the return and you're like, what happened to 5 Main Street? I don't see any activity. And Scott, the client, says,
yeah, I got rid of it.
I sold it.
I didn't tell you that. I forgot to let you guys know that it's no longer
and there's
part
no
of my portfolio.
paperwork, right? How much did you sell it for? And you might give me that. Oh, I sold it for $300,000. Great. Now what? And then your question to me might be, do I need to be worried about that, Ann? And I'm like,
They are. Depends.
That's a really good question, Scott. So working through that example, Scott, common tax client, sold the property for $300,000. The next question is, what's your cost basis, right? And this really matters in rental because your cost basis, if it was just a property you owned, right, as any asset, right, it's the cost you paid for it, your expense of selling it, so you probably had a broker, maybe you had to pay, some fees, all of that, right? That's just normal asset. But when you get into rentals, especially short-term rentals, the other thing that's factored in is the depreciation that was taken on the property. So if you're like, well, Ann, I don't owe anything. Remember that improvement you did that we wrote off 100% of last year? Well, that matters because the first thing we have to do is add back the depreciation and then calculate gain from there. So it's a very important element of your asset that is not really, we're not making a joke of it, but it's true that we need to track this every month and to have the conversation of the strategy behind taking things like a bonus depreciation or other things that we might do and how they impact your cost basis. Distributions, all of those things are added into the calculation of your cost basis. So really it's your initial investment, improvements, less any distributions, plus the add back potentially for depreciation, depending on how it's categorized from the IRS standpoint. Now we have an adjusted cost basis that we're going to put against that $300,000. So it may be the case that our adjusted cost basis is $100,000, $150,000. So now all of a sudden I do potentially have a gain or a loss, but we really want to know that before you sell. Right? Probably not after, right? We want to do that calculation first so you can go into the selling process knowing, yes, I'm going to have a gain, but I'm going to buy another property this year. I'm going to do another improvement this year. So I'm going to be strategic in what else happens this year to make sure that I, minimize my tax as much as possible, potentially, 1031 exchanges, all of those things we can talk about, but we have to know the gain loss first. So this is where tracking it, we really believe tracking it monthly, thinking about cost basis as we, move through the year, but especially at year end, it's the most important thing to make sure when you sign your return, everything's filed, just ask your CPA, your tax preparer, are you tracking my cost basis in this property? And if they're not, it's just something to bring to their attention to say, I'm really thinking of selling next year. Maybe it's something we can work through during off season to make sure that you're ahead of the game. So again, this is the 5th and final one that we've worked through, but it's really probably the most important because ultimately that gain loss could have a significant impact on the year that we sell the property. So thank you so much for joining us, and please feel free to reach out if you have any questions.